If you're concerned about the recent stock market volatility, and if your portfolio is concentrated with growth stocks, then adding a dividend stock like Chevron might be an interesting way to reduce the riskiness of your portfolio. So, in this video, I'm going to evaluate Chevron stock and answer if this stock is an excellent stock to buy for dividend stock investors, those that are trying to generate passive income, or even growth stock investors that are looking to add some diversification and risk reduction to their portfolios. I'll look at the company's revenue growth history, its profitability, its cash flow, its returns on investor capital. I'll then look at valuation. I'll share with you my discounted cash flow valuation model that I calculated, and I'll look at valuation on a forward price to earnings and price to free cash flow basis to answer if this dividend stock, which yields 4.15%, is a buy at current prices. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. One of the things to note with Chevron stock and other energy companies as well, oil energy companies, the revenue growth rate will be volatile and it'll depend on several factors, including the price of oil, demand, macroeconomic growth. All of that will play into revenue growth for Chevron. Longer term, the present administration in the United States is more favorable towards energy companies, is taking a more favorable stance towards energy companies, and is less interested in pushing electric vehicles down people's throats. That's good news for companies like Chevron, but I don't think investors should get too excited about the policies from the current administration because 4 years later, there could be a new administration in the White House, which could change strategies again. That's why I tell investors not to count on politics when you're making investment decisions because politicians change their mind very frequently. And especially with elections every 4 years, the administration changes every 4 years. And so policies change. And policies are rarely permanent. And so one administration can reverse the policies of a previous administration, just like we're seeing now in the United States with Donald Trump trying to reverse as many of Joe Biden's policies as possible. And then when Joe Biden came into office, he was trying to reverse Donald Trump's policies, et cetera, et cetera, et cetera, right? That's where electric vehicle stock investors got into a lot of trouble. They were counting on the United States government to really keep pushing electric vehicles. That's the only reason why that industry got as far ahead as it did is because of the significant amounts of government incentives that went into pushing that industry. So Chevron, one of the more interesting things that passive income investors look for and dividend stock investors look for is the dividend yield. And with Chevron stock, you can get a dividend yield of 4.15%. The company's operating profit margin was 9.78% most recently. And again, you're going to see volatility with oil companies like Chevron. It's going to be up and down. But what you'd like to see is higher highs and lower lows, which you get to a degree with Chevron. The most recent expansion, where operating margins reached closer to 15%, was much higher than the previous one, where operating margins were at roughly 10%. Right now, you're seeing the operating margin declining as oil prices are coming down off of those peak levels from 2022. If anything, the trend here for oil prices is downward. As I mentioned earlier, Donald Trump and the current Republican administration is more favorable to energy production, is more favorable to policies that lower oil prices rather than policies that encourage people to look for alternative energy, even if it doesn't make sense, even if it's going to be at way higher prices. The cash flow from operations to sales ratio, you're going to see similar types of volatility here. It's not going to be nearly as negative because of the significant amounts of non-cash expense. Most notably for energy companies like Chevron, you're going to see significant amounts of depreciation and amortization in the physical equipment they use to generate energy. So this is why the cash flow from operations will usually be better than the operating profit. And the cash flow from operations is usually a better figure to look at when evaluating energy companies or oil companies like Chevron instead of the operating profit margins. Returns on investor capital measures how good a company is at taking investor money and turning it into profits and cash flow. Now, you might say, well, Chevron is not getting money from investors. In fact, it's giving money back to investors with its incredible dividends. But they do take money from investors because they don't give you 100% of the profits in dividends. Anytime a company retains earnings, they're keeping investor money because that earnings is entitled to investors. If they don't pay 100% out to investors, then they're using investor capital to reinvest in the business. And they need to generate sufficient returns on that capital. Otherwise, investors are going to pressure the company to give more and more money back to investors because they're not utilizing the capital effectively. At the recent peak, you can see Chevron's returns on investor capital approached 20%, and they're now around 9.71%, which is reasonable. It's not great. You'd like to see returns on investor capital that's higher than the weighted average cost of capital. And for Chevron, its weighted average cost of capital is 10%, and the most recent return on investor capital was 9.1%. And looking back over the previous decade, it hovered around between 10% and negative 8% between the highs and the lows. These lows, of course, unprecedented because of the pandemic, and these highs, not unprecedented because there's usually some kind of event that causes oil prices to surge more often than there are events that causes oil prices to fall, especially because the Organization of Petroleum Exporting Countries does a good job of limiting production to keep prices high, and their influence on worldwide oil prices tends to lift prices more than it does to decreasing prices. Looking at valuation, Chevron is a relatively fairly priced business trading at a forward PE of 12.7, a price to free cash flow of 19. I would say between fairly priced and a little overvalued, given the company's fundamental performance on revenue growth, on cash flow, on ROIC, and cash flow from operations. I'd like to see a lower valuation from a company with these metrics on the forward PE and price to free cash flow basis. But looking at it from the discounted cash flow valuation model I calculated at $183 for the intrinsic value compared to the current market price of $158, it looks a little undervalued. So I would say this stock is a little, I would say it's about fairly valued, a little bit undervalued on the discounted cash flow, a little bit overvalued on the price to free cash flow. If you want to see the detailed explanation of my discounted cash flow model, you could join my channel as a member. I have member exclusive videos highlighting all of the discounted cash flow models. So to update my recommendation, is Chevron an excellent dividend stock to buy at current prices? I would say it's a fairly valued business, and I'm always willing to pay a fair price for an excellent business. Chevron is not quite up there as an excellent business, but it is a good business. So overall, I would rate Chevron stock as a buy, especially if you don't already own any energy stocks, because it adds so much diversification benefits to your portfolio if you don't already own any energy stocks, because you're most likely consuming a good deal of energy every month, and you're exposed to oil price fluctuations. If you own Chevron stock, it adds some diversification. If the oil prices go up, you're going to spend more money every month in fueling your car. But at the same time, Chevron stock price will rise to offset some of that impact from higher oil prices, and vice versa. If oil prices come down, Chevron stock price might come down, but then you'll be spending less money every month on fueling your car. So it does add nice diversification benefits to your portfolio. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.